Welcome back. Let me start with a story most people never forget. Once they actually understand it. A man visits a city. The locals proudly show him massive monuments. This one belongs to a banker. That one belongs to a stockbroker. And that one belongs to an insurance agent. After some time, the man asks a simple question. Where are the monuments of their customers? Everyone laughs. Because customers never made enough money to build one. This story comes from a book written 80 years ago by a former stockbroker. And here's the uncomfortable truth. The investment industry hasn't changed at all. The rules are the same. The winners are the same. Only the losers keep changing. And schools still don't teach financial education, so most people don't even understand how money actually grows. Today, I'll break that illusion. In this video, you'll learn what compounding really is, why banks, brokers, and insurance agents quietly avoid teaching it, and how you can actually use compounding to build wealth. Watch till the end. If you truly understand this, your financial thinking won't be the same again. What is compounding? Compounding means this. Your money makes money. That money also makes money. And the cycle keeps accelerating. That's it. No misteri. Now here's where most people fail. They can't visualize time. So let me give you a mental shortcut called the Rule of 72. Divide 72 by your annual return, and you'll know how long it takes for your money to double. At 7%, money doubles in 10 years. At 15%, every 5 years. At 22%, every 3 years. Now pay attention. If you invest 10 lakh at 22%, after 3 years 20 lakh, after 6 years 40 lakh, after 12 years 1.6 crore, after 15 years 3.2 crore.
Now here's where your brain breaks. After 18 years 6.4 crore, after 21 years 12.8 crore, after 24 years 25.6 crore, after 27 years 51.2 crore, after 30 years over 100 crore. If someone told you, you'll make 3 crore in 15 years and 97 crore in the next 15, you'd call them a liar. But that's exactly how compounding works. That's why Einstein called it the eighth wonder of the world. Those who understand it earn it. Those who don't pay for it. But the stock market is risky. This is the most common excuse. Yes, stocks go up and down. So how does compounding work? Here's the blunt answer. If people understood long-term stock returns, no one would buy most insurance policies or fixed deposits. Fear keeps the system running. People without knowledge chase safe returns. People with knowledge quietly buy assets. Long-term investors understand one thing. Short-term volatility doesn't matter. Quality businesses grow over time. Even if only one company in your portfolio succeeds massively, can outperform dozens of failures. And at the very minimum, index funds beat inflation. Which brings us to the real enemy. Inflation, the silent wealth killer. In 1995, 1 kilogram of wheat cost around 1.25 Indian rupees. By 2005, 5 Indian rupees. By 2010, 10 Indian rupees. By 2015, 50 Indian rupees. Today, anywhere from 30 Indian rupees to 150 Indian rupees per kilogram. Prices don't rise slowly forever. They rise in percentages. Official inflation in India may say 7%. Real inflation feels closer to 10%. Which means, if your money earns less than 10%, you are moving backward, not forward. Saving money alone guarantees struggle. Compounding always works, either for you or against you. Why safe investments make you poor. I know people whose pensions once paid for an entire year of living. Today, that same pension barely covers one restaurant bill. Why? Because their money grew slower than inflation. Some people even borrow at 18% interest to invest for 10% returns. That's not bad luck. That's financial ignorance. How the investment industry actually makes money. There are two sides. Buy side, banks and insurance companies. They profit when you lock your money for decades. Sell side, brokers. They profit when you trade frequently. Now here's the trap. A person tells me, I invest 2.4 lakh per year for 6 years. After 20 years, I get 50 lakh. Sounds impressive. It isn't. When you calculate the real return, the IRR, it's around 7 to 8%. That means lower purchasing power in the future, lower standard of living. It's not wealth creation. It's poverty with good marketing. Why brokers push trading? Brokers offer free courses, daily market updates, buy and sell calls. But every successful investor says the same thing. The stock market transfers money from the impatient to the patient. If everyone invested long-term, brokers would go out of business. That's why FD is sold as long-term. Stocks are sold as short-term gambling, which is exactly backward. The correct way to use compounding. Use banks and insurance for short-term needs, safety and protection. Use stocks and equity funds for long-term wealth creation. Even if you invest in 6 companies, 5 completely fail, and only 1 succeeds massively, you can still build serious wealth. That is the real power of compounding. Not hype, not luck, just time, patience, and math. If this made sense, you're already ahead of most people. And if it didn't, watch it again. Because compounding doesn't care. Whether you believe in it or not, it still works.